Good evening everyone, this is Beneviv or Amanse. We are the group 2 and we're going to tackle on chapter 5, which is the final income taxation. But before that, allow me to give a short overview and objectives for this chapter. So chapter 5 talks on the features of final income taxation, the items of gross income, as well as the class of taxpayers subject to final income tax. And one of the exemptions to the scope of the regular income tax is the final tax. And to master income taxation, you must have a thorough understanding of passive income items and those taxpayers who are liable to final tax, as well as the other final tax rates. And after we discuss this chapter, we students are expected to be able to demonstrate the following objectives. We have here to understand and appreciate the features and scope of final tax. B, we have the mastery of those certain passive income subject to final tax and their corresponding final tax rates. C, mastery of the general final tax rates on certain non-residents and their exceptions. And lastly, knowledge of the other applications of the final income tax scheme. So now let's proceed. What are the features of final income taxation? So there are 4 features of final income taxations, namely final tax, second, tax withholding at source. We have here the territorial imposition, and fourth, impose on the certain passive income and persons not engaged in the business of the Philippines. Okay, so to further explain the features of final income taxation, we have here the final withholding systems and how it works. So the final withholding system, so this imposes upon the person making income payments the responsibility to withhold the tax. Tax deducted at source is final, or tax that will be deducted at source is final. The taxpayer receives the income net of tax and no need to file an income tax return to report the same. So on the other hand, it is a tax wherein the payer withholds an amount from the payer's income and pays this amount to the government on behalf of the payee. Then the payee will no longer need to file an income tax for this income. And next, final withholding system is inherently territorial, and therefore it applies only to certain passive income earned from sources within the Philippines. And it was also stated in the book that taxation is territorial, therefore we cannot impose tax obligation to foreign subjects or to non-resident subjects of foreign sovereignty. So, meaning residents are taxed on their income from all sources within the Philippines. And likewise, non-resident citizens and aliens, whether or not resident in the Philippines, are taxed only on income from sources within the Philippines. Rates of tax also on income of aliens, resident or not, depend on the nature of their income. Like for instance, their compensation income subject to final tax, or other income. So that was just a brief explanation on the final withholding system, and the next reporter will further explain and discuss on the rationale of final income taxation, passive income, and the non-resident person not engaged in business in the Philippines.
The rationale of the final income taxation. So the final withholding tax is built upon taxpayer and government convenience. It relieves the taxpayer of the obligation to file an income tax return. This is very convenient for taxpayers who are limited by distance, time, and cost to comply. On the side of the government side, the final withholding system is the most convenient and effective system in collecting taxes on income where there is high risk of non-compliance or tax evasion. So, Under the NIRC, final income tax is imposed on certain passive income and upon non-resident persons not engaged in the business of the Philippines. So, on the next slide, let us determine or define what is a passive income. So, on the screen, it is defined as it is earned with very minimal or even without active involvement of the taxpayer in the earning process and are generally irregular in timing and amount. So, in here, the passive income are earned with little effort or even without involvement from the taxpayer. So, for example, interest income. So, in the bank, when you deposit your money in the bank, you do not exert effort in earning the interest income. That would be earned by your deposits in the bank. So, that is considered as a passive income because you have no involvement or any effort in earning that certain amount of income. So, next slide. So, non-resident persons not engaged in trade or business in the Philippines, such as non-resident aliens are not engaged in trade or business, and non-resident foreign corporations have higher risk of non-compliance. So, that is why they are subjected to final tax generally in all income earned in the Philippines. So, these are those people not staying here in the Philippines and they just come and go. And they are either engaged in business or not. And if they are engaged in business, definitely there's an income. So, that income is subjected to final tax because they have a high risk of non-compliance because they are always leaving. Parehas sa pagbiya niya sa ako. Char, joke lang. And aside from that, they do not maintain or they do not stay in the Philippines. Hence, they have to be subjected to final tax in all their income earned here in the Philippines. So, their distance and absence in the country make it very unlikely for tax compliance to be expected. Okay, so thus the law subjects them to final income tax, and Philippine residents shall withhold the final tax from their gross income, active or passive, from all sources. So this would be the table for the non-resident persons not engaged in trade or business. So the non-resident alien not engaged in trade or business and non-resident foreign corporations will have a general final tax rate of 25%. So next slide please. Passive income subjected to final tax. So let's remember this one. Not all passive income are subjected to final tax. So these are the examples of passive incomes that are subjected to final tax. So first is interest or yield from bank deposits or deposit substitutes, domestic dividends, in general, dividend income from a real estate investment trust, share in the net income of a business partnership, taxable association, joint ventures, joint accounts or co-ownership, royalties, in general, prices exceeding of 10,000, winnings, informers, tax reward, and interest income on tax-free corporate covenant funds. So, these are some of the examples for the passive incomes that are subjected to final tax. So, the rest of the reporters will be the one to discuss it.
Final tax on individuals and corporations. Final tax rates to be discussed apply to all taxpayers, individuals, and corporations other than non-resident alien not engaged in trade or business, and non-resident foreign corporation. Interest income or yield from local currency bank deposits, deposit substitutes, trust funds are subject to final tax as follows. So here is a table of the local currency deposits. From banks, individuals have 20% in short-term deposits, and as for the corporations, 20% deposits. Long-term deposit certificates, individuals are exempted. And as for the corporations, long-term deposits are the regular income tax. From non-bank institutions, short-term deposits or certificates is regular income tax for the individuals and as well as for the corporations. For the long-term deposits, regular income tax and in the corporations, regular income tax also. Short-term deposits are those made for a period of less than 5 years. As for the long-term deposits or investment certificates, it refers to the certificate of time, deposit, or investment in the form of savings, common or individual trust funds, deposit substitutes, investment management accounts, and other investments with a maturity of not less than 5 years. The form of which shall be prescribed by the BSP and issued by banks only. To individuals in denominations of 10,000 pesos and other denominations as may be prescribed by the BSP. So here is an illustration. A taxpayer earned the following interest income from various deposits. 6-month time deposit, 8,000 pesos. 2-year time deposit, 12,000. 5-year time deposit, 40,000. So the total interest income is 60,000 pesos. The required is the final tax if the taxpayer is an individual and if a corporation. So there will be two solutions. Number 1 is for the individual taxpayer. 8,000 times 20% is equals to 1,600. 12,000 times 20% is equals to 2,400. 40,000 times 0% is equals to 0. So if you add, the final withholding tax is 4,000. As for the corporate taxpayers, you will add 8,000 and 12,000 and then multiply it by 20%, which is 4,000. So as you notice, the individuals are exempted to long-term deposits or certificates because it is anchored on the fact that long-term deposits are usually channeled to a financing of long-term projects such as infrastructures, property developments, and other construction projects which are deemed essential to the development of the country. Deposit substitutes. It is an alternative form of obtaining funds from the public other than deposits through the issuance, endorsement, or acceptance of debt instruments for the borrower's own account. For the purpose of lending or purchasing of receivables and other obligations, or financing their own needs or the needs of their agent or dealer. Public means 20 or more corporate lenders at any one time. The 19-lender rule. The mere flotation of a debt instrument is not considered to be a public borrowing and is not deemed a deposit substitute if there are only 19 or less individual or corporate lenders at any one time. Note that the 19-lender rule does not apply to government securities because government debt instruments and securities including treasury bonds, treasury bills, and treasury notes shall be considered as deposit substitutes, irrespective of the number of lenders at origination if such debt instruments and securities are to be traded or exchanged in the secondary market. So here is the classification of debt instruments. Timing of withholding of final tax. Zero coupon instruments or securities upon origination and interest-bearing instruments or securities upon payment of interest. So here is a summary of tax rules on interest on debt instruments. Illustration. ABC company wants to take advantage of the decreasing interest rates. It disposed of its investment in various short-term deposit substitutes. It gained total of 300,000 from the disposal inclusive of 180,000 interest income. Only the 180,000 interest income shall be subject to 20% final tax. The 120,000 trading gain on the debt instruments shall be subject to regular income tax. Also, Forex gains on trading foreign currency denominated instruments, if any, shall likewise be subject to regular tax. Trust funds or investment management accounts. Investments in trust funds of banks or investment management accounts are subject to the same final tax rules. In order to claim the final tax exemption on long-term investment, it is mandatory that 1. The investment of the individual investor in the common or individual trust fund or investment management account must be held or managed by the bank for at least 5 years. The underlying investment of the individual trust account or investment management account must qualify as a deposit substitute issued by a bank. And the individual trust account or investment management account must hold on to such underlying investment for at least 5 years.
Trust funds or investment management accounts. Investment in trust funds of banks or investment management accounts are subject to the same final tax rules except for the qualified exempt employee trust funds. In order to claim final tax exemption on long term, it is mandatory that A. The investment of the individual investor in common or individual trust fund or investment management account must be held or managed by the bank for at least 5 years. Take note, at least 5 years. B. The underlying investment of the individual trust account or investment management account must qualify as a deposit substitute issued by a bank. And then C. The individual trust account or investment management account must hold to such underlying investment for at least 5 years. We have here illustration 1 to 3 from the book to further understand. So illustration 1, Mr. Acebo appointed the trust department of RCBC Bank to manage his money through a trust agreement. The RCBC Bank Trust Department invested Mr. Acebo's money in a 5-year corporate bonds. So the illustration 1 doesn't apply on the letter A mandatory I mentioned earlier, because in this situation, Mr. Acebo still subject to 20% final tax because the underlying instrument was not held or managed by the bank for at least 5 years. So illustration 2, assume instead that RCBC Trust Department invested Mr. Acebo's money in a 10-year time deposit under its own name without mentioning that it was in trust for him. So the illustration 2 also does not apply to the letter B of the mandatory to claim final tax exemption on long-term investment and is also subject to 20% final tax because it doesn't qualify and the investment was not made in trust for the name of specified and qualified individual. So for the illustration 3, assume instead that RCBC Trust Department invested the money under the name of Mr. Acebo's in a 10-year long-term deposit. So in this illustration, which is illustration 3, Mr. Acebo's interest income was from trust agreement will be exempted from income tax because he hold deposit or the investment in a continuous period for at least 5 years. The trust also hold the underlying instrument for at least 5 years because it is a 10-year long deposit. So if you can recall, this was from the letter C of the mandatory to claim final tax exemption on long-term investment. Pre-termination of long-term deposit or investment of individuals. So we have here table. So this table here signifies that if the deposit or investment placement of individual taxpayer is pre-terminated before 5 years, the pre-termination tax in the table will apply. So for example, the holding period is less than 3 years, the pre-termination tax is 20%. And any previous untaxed or exempted interest income will be subjected to the pre-termination tax that is on the table upon termination. We have here illustration for pre-termination on long-term deposit or investment of individuals to easily understand. So, in January 1, 2020, Patricia invested 1 million in Baguio Bank's 5-year time deposit. The deposit pays 10% interest annually. Alice pre-terminated the deposit on July 1, 2023. So the year that Alice pre-terminated the deposit is less than 4 years. That is why the pre-termination tax applicable is 12%. The 100,000 is derived from 1 million times 10%. The interest annually that is equal to 3 years, and to sum it up, it equals to 350,000 times 12% that results to 42,000. The net proceeds to be released to the depositor is 1,008,000 by adding 1,050,000 subtracted to 42,000, that equals to 1,008,000 net proceeds to be released to the depositor. Pre-termination, transfer, or negotiation of investment certificates. So for purposes of applying the pre-termination rates for individual taxpayers on long-term investment certificates, the remaining maturity of the instrument must still satisfy 5-year requirement. So another illustration here given by the book for the pre-termination, transfer, or negotiation of investment certificates. So illustration says that instrument with a maturity of 10 years was held by Mr. X. Mr. X was a resident citizen for 6 years, then transferred to Mr. Y, another resident citizen, who in turn held for 4 years until the instrument matured. So Mr. Y is subject to 20% final withholding tax because when he purchased the instrument, it is already less than 5 years. So foreign currency deposit with foreign currency depository banks. The interest income from foreign currency deposits under the foreign currency deposit system or expanded foreign currency deposit system by residents is subject to a final tax of 15%. So we have here a table, and it is shown here in the table that the taxpayer that is a resident, whether an individual or corporation, is subject to a final tax of 15%. Also, the non-residents are exempted, and the non-resident in the table refers to the non-resident citizen, non-resident aliens, and non-resident foreign corporations. Also, non-resident alien not engaged in business and non-resident foreign corporation are exempted. Also note that there is no long-term or short-term classification of foreign currency deposit. The foreign tax rate was reduced and has exemption of the non-resident deposit because it is intended to encourage the deposit of foreign agencies, because our currency here, which is the Philippine peso, is not accepted globally. And the deposit foreign currencies in our bank will be used in the financing of our international trade. Joint account of forex deposits. If the bank account is jointly in the name of non-resident and a resident taxpayer, 50% of the interest shall be exempt, while the other 50% shall be subject to 15% final tax. So we have here illustration given by the book. So illustration says that Mr. Seaman is an overseas Filipino worker. He deposits all his savings in a savings account under the foreign currency deposit unit of a domestic bank. During the month, the savings deposit account earned $1,000 interest equivalent to 41,500 pesos. So scenario 1, Mr. Seaman deposited his savings through the account of his resident wife. I've mentioned earlier on the foreign currency deposit with foreign currency depository banks. The interest income from foreign currency deposits under foreign currency deposit system or expanded foreign currency deposit system by residents is subject to a final tax of 15%. Since he deposited his savings through the account of his wife, which is a resident, the final tax rate is 15%. That resulted to a final tax of 6,225,000 pesos. For the scenario 2, Mr. Seaman deposited his savings through a joint account with his resident wife. Under the joint account of forex deposit, which I mentioned earlier, that if a bank is jointly in the name of a non-resident and a resident taxpayer, 50% of the interest shall be exempt, while the other 50% shall be subject to 15% final tax. The scenario 2 is a joint account, that is why 50% is exempt, and the 50%, which is 20,750, is subject to 15% final tax. Scenario 3, Mr. Seaman deposited his savings account through his own account. In this case, the interest income shall be exempt from final tax because Mr. Seaman is non-resident individual. Interest income subject to regular tax. The interest income from these five here, which is the lending activities, whether or not from the course of business, investment and corporate bonds, promissory notes, foreign sources, whether bank or non-bank, penalty or legal delay or default, the interest income from these sources is subject to irregular tax and not final tax.
Dividend. Dividends are any payments made by a firm to its shareholders from its earnings or profits, whether in cash or in other assets. There are 5 types of dividends. First is cash dividends. It is the distribution of funds or money paid to stockholders generally as part of the corporation's current earnings or accumulated profits. Cash dividends are paid directly in money as opposed to being paid as a stock dividend or other form of value. Second is a property dividends. It is an alternative to cash or stock dividends where a company gives shareholders property in lieu of cash or cash equivalents. Property dividends have monetary value even though they are considered a non-monetary type of dividend. Third is the scrip dividends. Scrip dividends is new shares of an issuer's stock that are issued to shareholders instead of a dividend. Scrip dividends may be used when issuers have too little cash available to issue a cash dividend, but still want to pay their shareholders in some manner. Scrip dividends may also be offered to shareholders as an alternative to a cash dividend, so that their dividend payments are automatically rolled in more shares. Fourth is stock dividends. Stock dividends is a payment of dividends to its shareholders that is made in shares of common stock instead of cash. Fifth is the liquidating dividends. Liquidating dividends is a payment made by the corporation at the time of complete or partial liquidation. It is a form of a return of capital, refunding the amount of investment made by the shareholders. Dividends are usually considered taxable income. Stock dividends and liquidating dividends, on the other hand, are not taxable income. It is because stock dividends, when you receive a dividend, the total value of the stock doesn't change. Instead, the basis of each share changes. Stock dividends usually don't have tax implications until you sell the shares. So the amount paid in cash for the fractional shares is considered taxable income. Liquidating dividends clearly are not taxed as dividends. Also, while the gain derived by the shareholders is the same as and often described as capital gain, the applicable tax is not the capital gains tax. Instead, the gain is included in the income of the shareholders subject to the regular income tax rate. Taxability of stock dividend. A Philippine corporation can distribute stock dividends tax-free proportionately to all shareholders. The subsequent cancellation or redemption of such stocks, however, shall be taxable to the extent that it represents a distribution of earnings. If it leads to substantial alteration in ownership in the corporation, when stock dividends are issued in lieu of cash dividends or when the corporation declares an optional stock or cash dividend, there can be a significant change in ownership in the company. Stock dividend versus stock split. Stock dividends reward the shareholders without lowering the company's cash balance but by diluting the market price per share and earning per share. These stocks are getting narrowly distributed in fractions paid per existing share If the issue is less than 25% of the total number of outstanding shares, then it is treated as a stock split.
Next is dividend tax rules. This dividend tax rules is for cash and property dividends because cash cash and property dividends is considered as income and stock and liquidating dividend is not considered as income. So if it's considered as income, so they are subject to final tax. So, dividends income received from a domestic corporation are subject to 10% tax. Corporation are exempt. Dividend income received from a foreign corporation are subject to regular tax, both individuals and corporation. By the way, regular tax is will be detailed in chapter 9. Non-resident alien engaged in trade in business is subject in, engaged in trade or business is subject to a 20% final tax. But non-resident alien not engaged in trade or business is subject to 25% tax. Non-resident foreign corporation is not exempt but is subject to 25% general final tax rate. However, this imposable dividend tax shall be 15% when the tax sparing rules applies. Tax sparing rules will be discussed later. Illustration number 1 shows that corporate shareholders does not have final tax and individual shareholders will have the 10% tax rate. And illustration number 2, you can see the different tax rate of the different citizens of the Philippines. Next is presumptive source of the dividend distribution. This can be found in National Internal Revenue Code, Section 73, specifically C. Any distribution made to the shareholders or members of a corporation shall be deemed to have been made the most recent accumulated profits or surplus and shall constitute a part from of the annual income of the distributee for the year in which received. I believe that this is related why the corporation are exempt to the tax. Exempt dividends, intercorporate dividends from domestic corporation exempt from final tax. Dividends from cooperatives exempt from final tax. Qualified foreign source exempt from regular tax. Again, this qualified foreign source will be detailed in chapter 9. Intercorporate dividends received by the domestic corporation of the residents of the foreign corporation from a domestic corporation are exempt under the NIRC to minimize double taxation. Intercorporate means two or more entities or corporations. For example, if like for this example, B owns 100% of the A Corp. During the year, A declares 100,000 dividends and in return B declares also the same dividends. The following tables illustrate the double taxation. As you can see, A Corp declares 100,000 and it was deducted by 10% final tax and the same as B. The same as B, the net dividends of A becomes of B will be the dividend declared of B because they are the same company or they are related company like Moranig mother and sister and a sister. What do you call that? isa ra company ba, isa ra sila company pero lahi sila og like branch like that. This is this is a form of the direct duplicate taxation. To eliminate the impact of double taxation, inter-corporate dividends such as those declared by A Corp to B is exempted from final tax. When the dividend finally falls to an individual shareholder, the 10% final tax applies. This is exemption extend to the business partnerships since business partnerships are considered as corporation under the NRC. Then exemption does not extend to the general professional partnership, exempt joint ventures and exempt co-ownership because they are not considered corporation under the NIRC. Entities taxable as corporation are subject to 10% final tax. 10% final withholding tax also apply to the dividends or share in the net income of these entities considered as corporations under NIRC and special laws such as real estate investment trust, business partnership, taxable associations, taxable joint ventures, taxable co-ownership. Real estate investment is a publicly listed corporation established principally for the purpose of owning income-generating estate assets. The following recipient of REIT dividends are exempt from the final tax: non-resident individuals, non-resident foreign corporation to claim the preferential tax rate pursuant to applicable tax treaty, domestic corporation or resident foreign corporation, overseas Filipino investors, business partnership, taxable association, joint venture, and joint accounts and co-ownership under the section 73 of the NRC. They are not tax they are exempt to the 10% final tax rate since final tax applies in the point of determination of the income, not to the point of the actual distribution.
Royalties. Under the regulations, the 10 preferential royalty final tax on books and literary works pertain to printed literatures. Royalties on books sold on e-copies or CDs, such as e-books, are subject to the 20% final tax. Royalties on cinematographic film and similar works paid to non-resident alien engaged and not engaged in trade or business or non-resident foreign corporations is subject to a final tax of 25%. Passive versus active royalties. Passive royalties such as those paid to landowners of mining assets, royalties paid to investors from companies that produce and market their ideas, and royalties paid under licensing agreements that transfer the use of trademarks are all subject to a 20% final tax. When royalties are received from an undertaking which the taxpayer is actively involved, they are considered action income and are subject to regular income tax.
Good day, everyone. I am Ace and I'm going to talk about prizes and awards. Under Chapter 6, Section 32B of the Tax Code, prizes and awards were titled as miscellaneous items, which will not be included in gross income and shall be exempt from taxation. Thus, prizes and awards are excluded from the so-called taxable income. Next slide, please. However, those are prizes and awards that was made primarily in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievement where first, the recipient was selected without any action on his part to enter the contest or proceeding. And second, the recipient is not required to render substantial future services as a condition to receiving the prize or the award. In addition, Still included from the definition are the prizes and awards from sports competition that are sanctioned by their respective national sport organization. So the existing question right now is, what are the taxable prizes? And if there's any, what tax must be imposed? Next slide, please. So the taxable prices will depend on the amount of the price. As to the slide, if the price exceeds 10,000 pesos, individuals will have 20% final tax and corporations will have regular tax. And if the price does not exceed from 10,000 pesos, both individuals and corporations will have a regular tax. Next slide, please. In about winnings, for individual income tax payers, winnings received from sources within the Philippines are generally subject to 20% final tax, except winnings from the Philippine Charity Sweepstakes Office or the PCSO games amounting to 10,000 pesos or less. Similar to prices, there is no final tax imposed on corporate winnings under the NIRC. Winnings that are not subjected to final tax by the payer should be reported as part of the regular income. Also, winnings from the foreign sources are subject to regular income tax. That would be all for my part. Thank you.
So now, let us proceed to the tax informer's reward. Tax informer's reward is the cash reward that may be given to any person instrumental in the discovery of the violations of the NIRC or the tax code, or the discovery and seizure of some smuggled goods. The tax informer's reward is subject only to 10% final tax. Now let's proceed to the requisites of the tax informer's reward. First, the definite sworn information which is not yet in the possession of the BIR. Second, the information furnished lead to the discovery of fraud upon internal revenue laws or provisions thereof. Third, enforcement results in recovery of revenues, surcharges, and fees, and or in conviction of the guilty party or imposition of any fine or penalty. And lastly, the informer must not be first, a BIR official or a BIR employee. Second, the informer must not be any public official or any public employee. And lastly, the informer must not be a relative within the 6th degree of consanguinity of those officials or employee mentioned in A or B. So now, let us proceed to the amount of cash reward. The amount of cash reward refers to whichever is the lower of the following per case. There are two cases. First is that 10% of the revenue, surcharges, or fees recovered and or fine or penalty imposed and collected. And number two, the reward limit is limited only to 1 million pesos. The amount of cash reward is subject to 10% final withholding tax, which shall be withheld by the government. So, for example, Mr. Pancho is provided information to the BIR leading to the recovery of 15 million unpaid taxes. So, the cash reward will be computed by getting first the 10% of the cash reward, which is the 15 million multiplied by 10%, and we will get the 1.5 million. And after that, the cash reward limit is only to 1 million. So according to the amount of cash reward, whichever is lower. So the lower price is the 1 million. So we will use the 1 million as the cash reward, and then we will subtract 10% final withholding tax, which is 100,000. So the net amount that will be released to the tax informer will be 900,000. So now let us proceed to the tax-free corporate covenant bonds. The tax-free corporate covenant bonds are the interest income of non-resident aliens, citizens, or residents of the Philippines on bonds, mortgages, deeds of trust, or other similar obligations of domestic or resident foreign corporations with tax-free or tax reduction provision, where the obligor shoulders in whole or in part any tax on the interest shall be subject to a final withholding tax of 30%. So in the table, you will see that the bond investor has only two categories, which are the individuals and the corporations, and individuals are the only ones subjected to the 30% final tax, while the corporations are subjected to the regular income tax. We must take note that the final tax applies to all individuals regardless of classification, and there is no similar final tax provision for corporate recipients of tax-free interest. Hence, the regular income tax shall apply. Thank you.
So the next slide is all about the exceptions to the general tax on non-resident persons not engaged in trade or business in the Philippines. The NRA NETB stands for non-resident alien not engaged in trade or businesses, while the NRFC stands for not recommended for further considerations. For the general final tax rate, we have 25% both to the NRA, NTB, and NRFC. So here are the exceptions. Number 1 is the capital gain on sale of domestic stock directly to buyer. It has 15% capital gain stock, both NRA, NTB, and NRFC. The second one is the rentals on cinematographic films and similar works. It has also about 25% of rentals to the NRA, NATB, and NRFC. The third one is the rentals of vessels. It has 25% of rentals to NRA, NATB, and 4.5% of rentals to NRFC. The fourth one is the rentals of aircrafts, machineries, and other equipments with 25% of rentals to NRA, NATB, and 7.5% of rentals to NRFC. The fifth one is the interest income under the foreign currency deposit system. So it is exempted both NRA, NATB, and NRFC. The next one is the dividend income, which has 25% to the NRA, NATB, and 15% if tax-sparing rule is applicable in NRFC. The last one is the tax on corporate bonds. It has both 30% to the NRA, NATB, and NRFC. The next one is the capital gains tax. As a rule, both NRA, NATB, and NRFC do not file income tax returns. Exceptionally, if they are required to file income tax returns to report their gain from dealings in domestic stock directly to the buyers. Ownership of the stock shall not be transferred to the assignee without the required return and tax clearance from the BIR that the tax on the transfer has been paid. The capital gains tax is the tax imposed on the gains presumed to have been realized by the seller from the sale, exchange, or other depositional capital. For the tax-sparing rule, instead of the general final tax of 25%, the NRFC shall be subject to the 15% final tax on dividend income. In applying the tax-sparing rule, the Supreme Court ruled that the NIRC does not require that the foreign law of the non-resident corporation must give a deemed paid tax credit for dividend equivalent to the percentage points waived by the Philippines, pointing that the NIRC merely required the country of NRFC to a deemed paid tax equivalent to that waived by the Philippines. Okay, so the following are the other final income taxes. The first one is the fringe benefits of managerial or supervisory employees. Number 2 is the income payments of residents other than depository banks under the expanded foreign currency deposit system, or the EFCDS, and the expanded foreign currency deposit unit, or the EFCDU. The third one is the income payments to oil exploration services contractor or subcontractors.
Fringe benefits tax is a form of tax that companies paid in lieu of benefits they offered their employees in addition to the compensation paid to them. The fringe benefits, it includes all the remunerations under an employer-employee relationship that do not form part of compensation income. The fringe benefits of managerial and supervisory employees are subject to a final fringe benefit tax. For the interest and other income payments to depository banks under the expanded foreign currency deposit system, the residents other than depository banks under the expanded foreign currency deposit system shall withhold a 10% final tax on income payments such as interest income on loans from expanded foreign currency deposit units or the FDU. And for income payments to subcontractors of petroleum service contractors, under PD 1354, every subcontractor, whether domestic or foreign, entering into a contract with a service contractor engaged in petroleum operations in the Philippines shall be liable to a final income tax equivalent to 8% of its gross income derived from such contract, such as the tax to be in lieu of any all taxes whether national or local, provided, however, that any income received from all other sources within or without the Philippines in the case of domestic subcontractors and within the Philippines in the case of foreign subcontractors shall be subject to a regular income tax under NIRC. Note that the 8% final tax applies only to subcontractors, whether individuals or corporations, resident or non-resident. Petroleum service contractors are subject to the regular income tax. Persons or entities contracted by a petroleum service contractor to locally supply goods and materials that are required by in or that are inherently necessary or incidental to its exploration and development of petroleum mineral resources are entitled to the preferential 8% final tax on their gross income delivered from such contracts. Note on special aliens, under the old law, employees of offshore banking units, regional operating and regional administrative headquarters of multinational companies referred to a special alliance are previously subject to a 15% final tax on gross compensation income. The special alien classification is now abolished by virtue of a presidential veto to the train law. As such, these employees are now subject to regular income tax if they are resident and 25% final tax if they are non-resident.
Hello everyone, I will be the last reporter. I will be reporting about the final withholding tax return up to entities exempt from final income taxes. So here, final withholding tax return. So kani siya, is a kind of withholding tax which is prescribed on a certain income payment and it is not creditable against the income tax due to pay on other income subject to regular rates of tax for the taxable year. So here, this final withholding tax return, it is monthly remittance return of final income taxes withheld. So, this monthly remittance form shall be filed in triplicate by every withholding agent or even a payer required to deduct and withhold taxes on income payments subject to the final withholding tax. Okay, so here next, deadline and place for monthly manual filing. So the return shall be filed and the tax shall be paid or before the 10th day of the month following the month in which withholding was made it. Here, letter A, the authorized agent bank of the revenue district office having jurisdiction over the withholding agent's place of business. Letter B, in places where there are no authorized agent banks. to the Revenue Collection Officer. Letter C, the authorized city or municipality treasurer within the revenue district where the withholding agent's place of business is located. So here, so why is it important man to have a monthly deadline and the monthly manual filing? So it is because it's important to file and pay your tax return on time to avoid penalties imposed by the IRS. Okay, like for example, there are failure to pay sa tax. For example, if payment due on May 17th, so and it is made on the June 20th, so the penalty is 1%. So if you try to compute 1 divided by 2% times the 2 month, which is the due on May 17 and it is made on the June. So January, February, March, April, May, and June. So there are 2 months or the partial months. So the maximum penalty is 25%. So okay, and as well as sa filing pod, lahi sad iyahang pamaagi sa penalty because it is based on the amount required to be shown on the return and not just the amount shown as due. Okay, so next is monthly deadline for EFPS filing. So when we say EFPS, it stands for Electronic Filing and Payment System. So kani siya this refer into the system nga kailangan jud for the development, and the BIR or the Bureau of Internal Revenue maintain this kind of system. So like useful siya through na ay electronically filing tax returns, attachments including the paying taxes due specifically through the internet. So here next is Group A, 15 days following the end of the month, which is gibalik naman ni siya sa last chapters. Example are the banking institutions, insurance, pension funding, and so on. Group B is 14 days following the end of the month. Example, the manufacture, repaying of furniture, a repair of furniture, manufacture in basic metals, coke, fuels, like that, chemical products, and so on. And Group C, they have 13 days following the end of the month. Retail sale, computer-related activities, and so on. And Group D, 12 days following the end of the month. Example, the air transport, recycling, post land, telecommunications, and so on. And the Group E, 11 days following the end of the month. Example are those private and public educational services, agricultures, fishing, and other service activities. Okay? So next, the quarterly filing. So the withholding agent shall file BRR Form 1601 FQ, quarterly remittance return of final income taxes withheld. So it is already discussed in the last chapter nga na different charges should be given if late filing and the payment taxes like surcharge, katong the interest itself for the loans and so on. So here, the next is entities exempt from final income tax. So foreign governments owned and controlled corporations. 2 is internal missions or organizations with tax immunity. And 3, general professional partnership. And 4, qualified employee trust fund. Okay? So what do you think, ang government entities are they tax exempted? Because, the government typically exempts organization from income tax entirely when they serve the public good. Mas daghan pa sila daghan silang mga nabuhat para sa tuwa, such as religious and charitable organizations, ingana
the government eliminates the tax burden of certain organizations, no, it helps them further promote the public welfare. So that would be all of my part and our reportings. So we hope that you learn something from us. Thank you.